Good morning, everyone. This is just funny. So welcome, Glenn. Great to see you.
Good to see you, pal.
I like your jacket.
Thank you.
Looking good.
Keep your hands off.
All right, no, you don't have to worry about that. Anyway, you may know Glenn as the co-founder of Silver Lake, which of course is the biggest buyout firm in the tech biz. But what you may not know about Glenn is his incredibly varied interests that he has and all the different things that he does. He's a part owner of the Boston Celtics, on the board of the New York Stock Exchange.
NASDAQ.
Excuse me. Did I mess that up, did I? NASDAQ.
You said
on the board of
York,
NASDAQ.
Okay.
Sorry about
Andy's
that.
not very good without the fact check.
I need some coffee. On the board of NASDAQ, excuse me to everyone. On the board of the Brookings Institution, on the board of Harvard University. And so we want to ask him about all those things, which is incredibly interesting. So let's start off and talk, though, about valuations in the equity markets, and particularly valuations of tech companies. Where do you think things stand right now?
So I put together some data, because you gave me a little warning on this question. And I think it's a very interesting set of issues. And the answer is not really clear, but let's just look at some, let's go through. But one of the things we say at Silver Lake is in God we trust, everybody else brings data.
Okay.
Right? And so, look, if you think about valuations, it's clearly an issue because we've had a long time period of low interest rates that have caused risk capital to move into risky assets. And consequent with that, some people think it's a cause, some people think it just happens to be coincidental. We've seen very significant increases in equity prices, mm-hmm. right? Dow Jones, S&P 500 near its all-time high. Dow Jones eclipses all-time high. A lot of people are now, those numbers respectively are 1985 and 17,000. Mm-hmm. Seems high.
Right.
Gathers interest. The Shiller, Robert Shiller's analysis, which looks at 10-year rolling PEs, backward-looking PEs, right. Back to the 1890s. Average number is 17 PE. During the dot-com boom, it got as high as 40. Right now, it's at 26.
All right.
Which is the highest it's been other than, Black Tuesday and the dot-com.
So stocks are too expensive.
Backward-looking 10-year PEs, mm-hmm. on average. Forward-looking S&P 500 multiple. Historical average is 16. We're now at 20. The dot-com boom was 40.
Okay.
So that doesn't suggest
okay.
You're kind of too high. You know what I mean? Mm-hmm. If you look at, now the other thing that's got people's interest, of course, is if you look at tech valuations, which is mm-hmm. the second thing. Mm-hmm. And there are some parts of the tech valuation world that cause people to raise an eyebrow and say, that's pretty amazing, right? Uber, 17 billion valuation, Airbnb, 10, Dropbox, 10, Palantir, 10, Pinterest, 5. Mm-hmm. Late stage venture has numbers attached to it that cause people to be interested in them. There also are high valuation multiples for M&A, mm-hmm. right? Nest, Oculus, WhatsApp, Instagram, JD.com, AutoNavi, all at very kind of high levels. My favorite one, by the way, and last year there were 15 companies that raised venture capital in excess of $1 billion. Right? My favorite is this thing called Sync. You've ever heard of it?
Yes. Yeah,
right? I love this. A social networking site that allows you to connect to celebrities for free. Right? It has one employee, I think it was, and 0 assets, 0 users, 1 employee, no revenue, and was valued at one point at $6 billion.
Doesn't it also have the SEC looking?
Yeah, exactly. It's a penny stock.
Right.
So those things people all look at and say, that's kind of nutty, right? But on the other hand,
right.
Tech companies only make up, so that's a piece of the market people look at and say, what's going on there?
Yeah.
Where you have these, but on the other hand, if you look at the broad-based technology valuations, you can see the tech companies make up only 19% of today's S&P 500 compared to 35% at its peak in 2000. And venture financing is 77% below in dollar value and 50% below in firms' 2000 numbers. And the IPO dollar volume is 73% below the 2000 peak.
So what do you conclude?
So the conclusion is that the overall markets are high relative, in large part because of low interest rates.
Right.
And the biggest concern is not, but on the other hand, they're not that much higher than historical numbers, except in certain areas where there's been a lot of money that's chased deals, right. Like in late stage venture and some of the M&A stuff that we talked about. And so what you really need to worry about, I think, is the path of interest rates and mm-hmm. the influence that's going to have on valuations rather than absolute valuations in the markets. And
Okay.
and that's the story of the next 2, 3, 4 years is kind of what is the path of interest rates, and that's a story about on inflation, unemployment, GDP growth, rather than the issue of kind of where tech stocks are valued.
Now, Tom Perkins says that when quantitative easing ends, the capital will start flowing to less risky, higher yielding investments. So isn't that going to be bad for your business?
Oh, no. I mean, let's dissect that. First of all, is Tom right? And if he's right, is that going to be
Right.
bad for the
Okay.
business, right? And I think he's probably right, but not in the way that it sounds. In other words, as we move to a normalized economy, where interest rates get to the levels that are average rates, then this aversion to fixed income that most investors have right now will return to normal levels because you'll be able to get a reasonable amount of return from owning fixed income securities.
Right.
Right. And that's a very healthy and good thing that happens. Now, will that mean that there'll be a rebalancing of some money that comes in to the markets away from equities and toward fixed income? Perhaps.
Right.
Right. But remember, there's a lot of new flows, so that doesn't mean there's less money in equities as a result of that.
Fair enough.
It just means that people's future allocations, they'll fill up the bucket of fixed income that's low now because they don't have it now.
All right.
And that means that the economy's doing well.
Right.
In other words, the only reason why the central bank policy around the world will enable those rates to go to those levels is because the economy is doing well,
Right.
which means the companies will be doing well.
Right.
Which means on an average basis, you expect those equities to be higher not because of the multiple, but because of the earnings piece of it.
Let me
So
switch over.
I'm not sort of worried about that.
Okay, let me switch over to companies. So some of the big investments you've made historically have been Seagate, Skype. Two big ones now are Dell and Alibaba. Why?
When you say me, you mean Silver Lake. I wish I could take individual credit for all
Well,
those, but it's a big team.
You kind of
Right.
benefited a little bit, though.
Okay, I agree.
All right, so
but it's a big
talk
group
about
of people
those.
that made those
Yes.
investments.
Talk about your latest two investments.
Well, today we announced an investment in, I'll talk about my latest one. I'm actually talking about my latest two. One is an individual
So you don't want to talk about Dell or Alibaba?
No, Michael Dell and Jack Ma can talk about Dell and Alibaba.
All right, but you haven't obviously invested 20% in Dell.
And we're on a large shoulder
20%
in partnership with Michael Dell and Dell.
Okay.
But so yesterday we announced an investment in a company called Quorum, which is technology for the energy sector. And it's one of the great two pieces that it's important. One is it's one of the great technology stories in the world, which is the use of, one of the things we do at Silver Lake is to think about what you call applied technology or technology-enabled businesses. And the energy sector, which you think is the grimiest, most capital-intensive, most traditional old economy business, has had this huge renaissance associated with fracking that has been facilitated fundamentally by technology.
Right.
You know what I mean? It is now a technology-enabled industry in ways that we would not have thought about, and this company is part of that technology ecosystem around energy. And that I think that's really cool because those are the two most rapidly growing parts of the U.S. economy, technology and energy. To be able to bring them together in one place in one investment is really fun.
So you guys
Thing to
always,
do.
look at the cycle, and is now a good time to be investing in the business, in the sector, or you're either buying or selling in kind of a big way? What are you doing right now? Are you buying?
Well, look, it's some of both. The good thing about the technology economy is that it has a set of growth rates and sort of economic gravity independent of cyclicality. The iPhone came out, and the iPad came out in one of the worst economies we had in our lifetime, and was one of the most successful consumer products ever. Right? A great technology product will sell in almost any kind of cyclical situation. Plus, what you find, that's consumer. At the enterprise level, what you find is that there's actually an increase in some investments in technology in bad economic times because people are trying to secure efficiencies in their businesses. And so you don't really think about cyclical factors when you're investing in the technology industry. You're thinking about secular technology trends. And so that's on the other hand, there are lots of companies going public these days, and and there's a big IPO funnel, and everybody in the investment industries has deals in the IPO pipeline because this is the time when the markets are receptive to that. Investors want to buy those things. So it's quite natural right now that you're both, I think, investing and selling.
As I tried to spit out earlier, you're on the board of NASDAQ. The NASDAQ's had a lot of issues lately. Bob Greifeld, CEO.
Right.
Doesn't the NASDAQ need new leadership, Glenn?
I don't think so. So all the things I'm on the board of have CEOs who speak for the company, and that's not me. And one of the things I say to the people whose boards I join, or especially if I make an investment in the company, not only am I incapable of running the business, but I don't want to, and the only times I have to run them is when the things fail, so let's not get there.
Okay.
You know what I mean?
Yeah.
So, but each of them has a CEO that runs it, and that's a question that you should address to him, not me. But let me just say that about NASDAQ, I think, has been you should understand that NASDAQ has been a huge success.
Fair enough, but it's had some
Right.
issues, so you
But-
guys are
but
working
over
on
the
that.
course of the time period I've been an investor, and remember, I think about investing in 5-year increments, not 5-minute or 1/4 increments.
Okay.
And the value of NASDAQ, when I've been associated with it, has grown by a factor of 5. And it's grown from being a single product company to a global business. And it has fundamentally beaten the New York Stock Exchange,
Well, there may be some
which
people who
capitulated.
take issue with that.
So we've had a management team that's done a very, very good job. That said, every company has to have at the board level a succession plan. Every company. I'm not making a NASDAQ comment now. And so there have been news reports about the board talking about succession.
Yes.
And that's the product of a normalized succession plan that has to happen in any business. And if you don't have a succession plan at the board level in your business, you're not doing your job right. But you shouldn't overinterpret that as representing something other than ordinary course business in the boardroom.
You are very interested in public policy. You worked in the White House. Do you think it's incumbent upon CEOs, business leaders, to be actively involved in political process?
Well, I think there are a couple of answers to that. I think it's incumbent to all of us who've been fortunate enough to be successful in whatever we do, to be engaged in our communities. And whether that's involved in the policy process or involved through your local church or in the school system or in the Boys and Girls Clubs or whatever it is, you can make that choice. Right, so I think it's just important for all of us to understand that being a part of making a contribution to our community is important. So that's one thing. Secondly, for people who operate at a senior level in our economy, I think it's quite important for them to be involved in the policy process, not necessarily the political process, because their insights are very important to policymakers who are not engaged in the work and don't fully understand the work that they do. So that's right. And they're very good organizations. The technology organization called TechNet, the business organization called the Business Roundtable. That's very important engagement. From my perspective, I've also taken a real sort of strong policy interest in economic policies that relate to business success, because I think that some small number of us need to be able to be deeply engaged in the process in order to guide the policy-making process in a way that's likely to generate the most economic growth and create the least amount of friction in the system as we try to put in good regulation and good controls on the markets. But I don't think that's just kind of one thing that interests me, and I think some small number of us should be engaged in that, and I'm happy to do it.
Prevailing wisdom is that, or says that the tech industry does not create enough jobs. What's your take on that?
Well, I'm not sure what the word enough means.
Yeah, I know it's
a
straw man.
It's a really interesting question, which I think we have to unpack in a couple of ways. The first is that you have to make a distinction between the uses of technology that substitute for labor over longer periods of time, because there has been over the course of time, technology is always the invention of agricultural equipment substituted for agricultural labor. I mean, that's part of progress. Right. That's not new to technology. And we also have to think about one of the problems. Let me take one step back. One of the problems we have when we talk about these issues is we think the United States is this sort of self-contained, like a bathtub that fills up or goes down. And we don't think about it being as part of a global economy. And so it is for instance, there's this notion that there's been a decline in the middle class generally. There has been a lot of stresses on the middle class in the United States, but there's also been a huge increase in the middle class around the world. So you can look at this question of the middle class from a U.S. perspective, a global perspective, reach two very different conclusions.
Yeah.
You can have the same thing about the influence of technology on jobs. So a lot of what's been called outsourcing has caused a meaningful challenge to labor markets in the United States, but has significantly expanded job opportunities in places around the world. And depending upon where you sit as American or Chinese perspective or global perspective, you have different things about that. So that's kind of one piece of it. There's another piece of it, which is but I think as Americans, we have an incumbent responsibility to kind of do something about the U.S. implications of it. So I'm not meaning to downplay that. We can come to that later. But there's another piece of it, which is the wealth and economic growth and job creation happens as a result of new companies being formed that create jobs and market value. And that's another piece of technology which is undoubtedly really, really good. And how those two things balance out. Let me give you an example. The energy economy, which is now a tech-enabled economy, is going to create 1.7 million jobs over the coming decade, according to the McKinsey Global Institute estimate, in the United States.
In the United States alone.
Right, 1.7 million jobs. I went recently to Williston, North Dakota, which is the sort of the fracking boom. You know, we're talking about whether should we have a minimum wage increase? $7 should go to 10, which is basically should people make $14,000 or $20,000 a year? I mean, if you think about that, that's a debate where my personal view we really shouldn't be having. It's obvious that we need to pay people a little bit more at that end of our economy. But in Williston, North Dakota, they cannot find people to work in Walmart. They pay $20 an hour and they can't get people to work there because that's not a good enough job in that economy, which has zero unemployment. So when you go to Walmart, you take your own box cutter and you cut open the pallets to pull out whatever you want to buy. And then you go up to the checkout counter and you check yourself out because there's nobody working there because it's not a high-paying enough job.
Sounds like it might have a shoplifting problem, but that's. Anyway.
But you know, so the point is, do we want to have an economy that looks more like that with the right set of controls, environmental and regulatory controls around it, as a result of investing in, right? Obviously, yes. And so if you think about, and that's just one example of many of where technology is fundamentally transforming an industry and creating a huge amount of growth that creates jobs. And those jobs I gave you are just jobs in the industries, are not in the economy around them. And there's some notion that for every job you create in an industry, then you somewhere between 3 and 4 jobs you get created in the communities around that. For where the kids go to school and where the people shop and where they, and all the services that go along with building a community.
Great. Questions from the audience at this point? Does anyone have a question for Glenn about private equity, the buyout business? We
could ask Andy what it's like to be part of an independent company now. You guys put some leverage on it.
I'm not the CEO, so I can't. See, I don't pull. I will tell you.
What's it like being on a levered balance sheet?
No, I'll tell you. If you talk about what's going on at Dell, I'll tell you what's going on at Time 8.
All right, the question from the audience.
From the audience. I'm happy to
Glenn,
talk. You're the one who's not talking, dude.
You're getting another one from Fortune. Glenn, so let me know.
Where are we? Who's there?
Here,
Hey,
Dan.
Glenn,
hey, Dan, how you doing?
Dan Primack.
When you guys did buy Dell, which almost closed at this conference last year, so I won't ask you to speak about Dell, but about the process. You guys kind of battled Carl Icahn for a lot of that process for almost a year. So 2 questions. One, do you believe Carl Icahn understands technology? And secondly, what did you learn from that battle, which lasted so long?
Next question.
No. Come on.
I think the first question you have to ask him, because I don't know. I don't think I've ever met the man, or not in 30 years.
Carl Icahn?
Yeah.
You never met him?
So I don't have any idea about it. But I just think that what you learn from something like that is you keep your head down, you get up every day, if you know you're doing the right thing, you're going to win in the end. And so that's what we did.
I can tell you that Dan Primack is not satisfied with that answer.
Yes, I know. Dan and I have been friends for a longer period of time. We've had many of these jousts.
Well,
I respect what you do. I read your comment, but I'm not going to give you any copy today.
Your friendship is being frayed. Anyway,
no,
it's question
not.
over here.
Is that, were you okay, Dan? Are we okay?
We have a question over here? Nope. All right.
Way in the back.
It's
Lashinsky.
You're getting all fortuned here, Glenn. Adam Lashinsky with Fortune.
So why don't you tell us what it's like being in a highly leveraged
He will when you talk about your Dell investment.
Exactly. I thought what you said about the Walmart in, was it North or South Dakota, the $20 an hour?
North Dakota.
Was fascinating. It strikes me as such a trivial free market solution. In other words, it's almost impossible for that situation to persist for more than, some small amount of time. What am I missing? I would think somebody would move to North Dakota for that $20 an hour job.
No, it's going to happen. But it takes time, right? So one of the things we also did when I was there was to visit these what they call man camps, which the same companies that built the camps in Iraq Iraq are now building them in North Dakota to house the people who were there, and they literally just don't have the infrastructure. So I sat down for lunch with 8 guys who were on a fracking crew, and they work 12 hours on, 12 hours off for 2 weeks. Then they go home for a week and they come back. Then one guy was a bartender, one guy had been a cab driver, one guy had been a construction foreman. They're from all over the world. They're now making about $100,000 a year at these jobs. And so if you can get to Williston and you can find a place to live, then you can take that job as opposed to the job at Walmart. Now, over time, they'll build an economy there. They're having to build everything. Now I can't remember the exact number, but if there's 12 kids in the 9th grade class, there are 30 in the 3rd grade class. So everything has to expand. They need teachers, they need schools, they need firemen, they need policemen, they need houses, they need everything because this economy is growing so rapidly. Another thing that's interesting, when you build when you frack a well, you get about 50% of the production pretty quickly from natural pressure. Then you can put the pad on top of it with the thing that goes up and down. That gets that for the next 40 years takes the other 50% out.
Right.
Each of those pads is one half of a full-time job for 40 years.
Right.
So every 2 of those is one very well-paying job that lasts for 40 years. So over time, you'll get to an equalized, stabilized economy where you'll have something that looks more like what we have today. But today, the demand for labor is so great and the funnel to get there is so tight because they don't have the infrastructure, that's where it ends up.
Glenn, we're almost out of time. I got to ask you one 30-second question, or a question with a 30-second answer. How in the world are the Boston Celtics going to compete with the Cleveland Cavaliers and now the New York Knicks with Carmelo? I mean, what are the Celtics going to do, Glenn? Your team.
Win.
How? With whom?
So I think that 2 things. One is that of all the good news stuff, bad news stuff that's happened in the NBA in the last year, so LeBron James going back to Cleveland is a really good news story.
Yeah, it is.
I think
Real
that's
good
really
story.
fantastic. I feel really good about that. What we're trying to do is just like I talked about investments. When we bought the team in 2002, we said we were going to win a championship in 5 years. It took us 5.5.
All
So
right.
5.5 years later, we're standing up there with the trophy and the ring and everything. And so when you rebuild a team, it takes another 5 to 6 years to do that. And we're sort of in year 1 of a 5-year plan.
Fair enough. All right, Glenn Hutchins from Silver Lake, thank you very, very much.
Thanks for having me, pal.
Okay, really enjoyed it. Okay. Yeah, take your thing.